Welcome back to the Finance Shark YouTube channel. In this video, we're going to tell you about 10 personal finance opportunities when interest rates are rising. The video is going to be amazing, so make sure you stick to the end. Firstly, we're going to speak about why it is important to invest when interest rates are rising. There are a number of reasons, but the most important one in our eyes is that when interest rates go up, it means that there is a different demand for investments and your options become different. This means you have an opportunity to move into a better investment, which is going to be profitable over time. Secondly, the interest the bank pays you is also increasing, which means your money is going to earn more and you can reinvest it and it will grow faster. Before starting the video, be sure to smash the like button and subscribe to never miss out on any of our videos. An interest rate is simply the amount charged by a lender to a borrower for lending money, which is often referred to as the annual percentage rate, or APR. Investors watch interest rates closely and carefully. In some cases, high interest rates are good news, such as when an investor is expecting a return from a high-yield financial account or investment vehicle. In other cases, high interest rates can hurt a portfolio's performance. In those cases, investors will want to be prepared for sudden market changes. When interest rates increase, the public may see the effects of this move by changes in mortgage rates when they are trying to buy a home or increased APR on credit cards from financial institutions. But that's just the tip of the iceberg. Meanwhile, as interest rates increase, money becomes expensive. Credit tightens, which means that it becomes harder to raise, borrow, or lend capital. This creates a bigger hurdle for businesses to grow, expand, invest, hit projections, and also hire. Here are 10 ways to prepare for rising interest rates. Number 10. Stay diversified. If you have a stash of cash, no debt, one 401k, and a solid income, you're missing a huge opportunity by not diversifying your portfolio. If you tend to be a more fiscally conservative person and you don't want to take too many risks, make sure you consult a financial advisor to determine which investments may be right for you. The US and several trading partners are announcing tariffs and retaliatory tariffs as the world seemingly crawls toward an extended trade war. Oil is on the rise, but unusual global capacity is at least helping to keep energy in check. For that reason, the most common advice by advisors was to stay diversified. In other words, don't put all your eggs in one basket. Hold baskets of stocks, bonds, commodities, and even a little cash. Don't go all in on any one thing. That doesn't mean you should target a perfect balance. A few overweight makes sense. Craig Burke, Executive Vice President of Portfolio Management at Personal Capital, a San Francisco investment advisor, says adjustments to make when interest rates are rising may include adding banks and brokers, which benefit from higher interest rates, and cutting out lower-yielding dividend stocks that act as a proxy for bonds. Number 9. Consider corporate bonds. Another smart strategy is to invest in corporate bonds. You can structure this based on income needs, and then you're never forced to sell and can simply hold them to maturity. And keep in mind, you don't want junk bonds. You want quality bonds that have a AAA or AA rating according to Moody or Standard & Poor. Because short-term bond funds are constantly buying new bonds to replace the ones that have just matured, they can take advantage of the rising interest rates that crush the value of long-term bond funds. If you're a hands-on investor, you can eschew bond funds in favor of picking out your own short-term bonds or CDs. For these purposes, it's best to stick with investments that will mature in 90 days or less. You can even build a short-term bond ladder using 90-day securities, buying new ones every month to replace the old ones as they mature. As a rate boost brings better returns to savings vehicles, people should enjoy better paydays by putting their money in CDs and savings accounts. Number 8. CD ladder. The best way to take advantage of rising interest rates is through a CD ladder. This strategy involves opening and maintaining multiple CDs with different maturity dates that will provide you with regular, periodic cash flow and eventually allow you to reinvest at higher rates when they mature. It's important to note that even though these CDs come due around the same time, you shouldn't expect to receive the same interest rate you originally invested in. That's not how it works. The bank will take market conditions into account when setting new rates for maturing CDs, and that means your return will fluctuate, just like the stock market does. Higher interest rates on CDs and other financial instruments will particularly help older Americans trying to live on their retirement savings, commented Lynn Reeser, chief economist at Point Loma Nazarene University in San Diego. As the population ages, Many more Americans will come to appreciate even modest increases in interest income during retirement when they buy certificates of deposit. Number 7. ETF diversity. Exchange-traded funds are like mutual funds in that they hold large baskets of assets, such as stocks and bonds. However, unlike mutual funds, they trade on exchanges and can be bought and sold just like stocks, with prices that change throughout the day. And several financial advisors love ETFs as a way to execute the previously discussed strategies without buying individual stocks or bonds. ETFs also provide investors with much broader diversity in terms of stock picking strategies, including geographically diversifying. Don't tempt fate. Investors should never be tempted to time the market when it comes to interest rates, because you could end up losing much more than anticipated. And when you're buying individual securities like bonds funds, you're essentially buying loan-based assets, which can fluctuate. You don't want to be told that interest rates are going up or down. You need to look at the big picture and think about all of your investments, says Bogle. In a market such as we are seeing now, ETFs are going to be a great option for many investors and can help limit some downside potential while capturing growth in the sectors and asset classes that are performing, Michael Wendell says. Just one warning, Carbone of Cornerstone Wealth agrees that ETFs control costs, but they don't pick and choose. They invest across an asset class, buying a group's dogs as well as its stars. Number 6. Monitor inflation. Most broad-based measures of prices indicate inflation has continued to remain under control in the U.S. in recent years. The central bank's target for inflation is 2%, but inflation has yet to hit the bullseye on a sustained basis, as measured by personal consumption expenditures, or PCE. If the Fed achieves its objectives in steering the economy, inflation should remain under control. A positive inflation scenario after a rate increase might include lower prices of imported consumer goods due to a likely higher exchange value of the dollar if our domestic rate increases are not matched by policy tightening in other major economies, says Daniil Manenkov, U.S. forecasting specialist at the Research Seminar in Quantitative Economics at the University of Michigan. A negative inflation scenario after a rate increase might include higher prices on some more labor-intensive goods due to increased demand as the U.S. economy regains traction, Manenkov says. Number 5. Dividend stocks. Dividend stocks, like bonds, deliver regular income to holders. Their advantage? They can grow their payouts over time, and they typically have much more potential for capital gains. Clorox, CLX for instance, yields just 2.7% at the moment on a 96-cent quarterly payout. However, 10 years ago, the dividend was just 40 cents. If you bought it around $57 a decade ago, you're enjoying a 6.7% yield on your original investment. Plus, your asset value has more than doubled. The iShares 7 to 10-year Treasury Bond ETF, IEF fund, of medium-term bonds is up just 17% in that time. Wells Fargo's Davidson says rising dividends are a great hedge against inflation. Look for consumer-related stocks that benefit from pricing power, such as Clorox, he says, or those involved in commodities. They never raise the coupon of a bond, Thomas adds. They may call your bond and try to sell you a lower rate when interest rates fall. You don't necessarily have that problem with dividend stocks, though there is the risk of a dividend cut, such as what General Electric, GE, implemented in November 2017. Holding dividends is not always without problems either. If you're buying individual stocks, you could be subject to the whims of the company's board, which decides how much it pays out each quarter or year. So what if they decide they need to cut back on payouts? ETFs allow investors exposure to multiple dividend securities within a portfolio, which is a higher level of diversification than individual stock holdings, Wendell says. In the event that some of those securities pay lower dividends, the investor still receives some dividends from other securities in the ETF. Styles may not be as varied as they are with ETFs, but if you're looking for income stocks or dividend ETFs, a little research will help you find a few companies that will return value over the long term. Number 4. Evaluate savings interest rates. If you're a saver, low interest rates have brought about the financial equivalent of a long drought. Any improvement, even modest, is welcome and overdue. Just as with inflation, evaluating interest rates over the past few years is a bit like comparing apples and oranges. Since 2012, both savings account rates and CD rates have soared, then plummeted, largely in response to Federal Reserve policy. It's good to check your savings account and certificates of deposits, CDs, or other high-yield savings accounts on a regular basis to make sure you are not losing value over time because of inflation. Savings rates typically grow at about the same pace as inflation. Interest rates have been so low for so long that many people have fallen out of the habit of rate shopping, says Robert Frick, corporate economist for Navy Federal Credit Union. But now that rates are rising, they should get back into the habit and will be seeing bigger payouts from their accounts, especially certificates of deposit. This is especially important for people on fixed incomes. Number 3. Cash versus gold. In a world of negative interest rates, cash is king. In fact, there was talk from the European Central Bank about charging people for holding it. Cash has been king since savings rates plunged to 0 and below, Frick says. But now that the Fed has begun raising them, people should start comparing their returns with high interest rates they could get through a CD. That said, what happens when rates are rising even faster? Cash doesn't have the same principles. Ray Dalio says cash is trash, and rising interest rates and inflation will be like a tax on consumers, reducing consumer spending capacity. Many people are turning to gold when they are concerned about rising inflation. With rising interest rates, gold prices are likely to fall in the long term. Gold is a commodity with rising demand when investors turn to inflation hedges. However, it is low yield when looking at returns on investments, which makes it less attractive right now in interest. Graham Summers, president and chief market strategist of Phoenix Capital Research in Alexandria, Virginia, and author of The Everything Bubble, warns that if interest rates really take off, it could create a debt bubble 10 times bigger than the one that caused the Great Recession. If that happens, the best place for you to be, he suggests, is in cash or gold. He wrote for Gold Eagle that the early February market sell-off was stopped only by central bank intervention. No one says you must put capital to work, he says. Sometimes you just need to protect yourself and wait for the smoke to clear. Number 2. Treasury Inflation Protected Securities. TIPS. For Treasury Inflation Protected Securities, or TIPS, the Treasury Department uses the Consumer Price Index to adjust the principal for inflation or deflation twice a year. At maturity, the investor gets either the inflation-adjusted principal or the original principal, whichever is higher. They can be a great way to capitalize on rising interest rates. However, it can be difficult and complex to hold individual TIPS. Remember what a corrosive impact inflation has on wealth, says Eric Davidson, Chief Investment Officer for Wells Fargo Private Bank in Chicago. Even at today's levels, add taxes to inflation, and you have to earn 4 to 5% just to break even. TIPS can help maintain a portfolio's value as rates rise, he says. J.J. Feldman, a portfolio manager with Miracle Mile Advisors in Los Angeles, specifically suggests the Guggenheim Floating Rate Strategies GuyFax Mutual Fund, which puts at least 80% of its net assets in floating rate instruments and has a 4-star rating from Morningstar. Number 1. Consider real estate. Real estate assets should keep pace with inflation. In 2015, the Federal Reserve raised rates only 0.25%, but Wall Street has been anticipating more hikes in 2016, so it remains to be seen what effect rising rates will have on real estate. Rising interest rates should bring down the prices of real estate assets. For example, rents are likely to fall in the face of higher interest rates, but don't expect a real estate price crash. But long-term, due to rising inflation and interest rates, real estate is going up. When inflation rises, rent will rise, but it may not be too noticeable due to the fact that many people would like to live in an area where their job or school is. Very little moving around or commuting. According to Jonathan Smoke, chief economist for Realtor.com, people should take a look at real estate as a way to diversify their portfolios because it doesn't have the same volatility as those other two asset classes. However, real estate prices may be higher than they were before the recession and may not keep up with inflation. The real estate market might have a little more headroom to go up before it becomes unaffordable, but that doesn't mean people should rush out and buy a house, Feldman says. They need to consider how much risk they are willing to take on from an interest rate standpoint. This was all for today. Hope you liked the video. Do not forget to subscribe to our YouTube channel. Stay safe, and we will be back soon with another video.